Hello everyone. Welcome to The Intelligent Investor, a book on value investing, written by Benjamin Graham. This book is a must read for anyone who wants to take a plunge in value investing but just didn't get a chance to read, and for the ones who couldn't muscle through beyond few pages. I'm planning to post a quick overview chapter wise and will try to keep it simple and short. After reading this book, wonder why schools teach us how to work for money, instead wished they teach how to make money work for us. Benjamin Graham, popularly known as the father of value investment, wrote this book way back in 1949, and then later it underwent number of revisions during 1954, 59, 65, and finally 1973. The latest reprinted 2003 version, which I am referring to in this review, is the fourth edition, which has Jason Swick's commentary with Warren Buffett's preface. Though this book is about 70 plus years old, the concepts still stay intact, hence known as the Bible for the investors. Well, Benjamin Graham has a great legacy, in which, amongst many, Warren Buffett is one of his notable disciples and who is the fourth wealthiest person in the world, worth $71.7 billion as of July 2020. List of other disciples are Irving Khan and Templeton, just to name a couple of them. Warren Buffett had shared his experiences about his guru in many of his interviews, but quite often he refers to Graham saying that every day do something foolish, something creative, and something generous. Warren Buffett adds that Graham excels in being generous of disseminating his knowledge on investing, and hence says that by far this is the best book ever written so far. Graham has structured 20 chapters in this book, and 3 of them are considered to be a compelling one. In chapter 1, he helps you to identify yourself if you're an investor or a speculator. And in chapter 8, Ben introduces a fictional character, Mr. Market, and emphasizes the importance of mental and or emotional discipline. In the last chapter, number 20, he sails us through the margin of safety concept. In general, this book demands reading it in iterative mode. The more you read it, the better it helps you to evolve as an intelligent investor. Now, let's get into the first chapter, investment versus speculation. Here, he helps us to take our first and foremost step by helping us to discover who am I and what are my financial goals. Ben Graham doesn't give you Simon Pure strategies but guides us through to understand the financial market. Before pumping your money into any stocks, if you are digging deep about the company's details and convinced that that particular stock may help your money to grow and also it adds value to what you're buying, then you are an investor. And this doesn't happen overnight or in a fortnight. It's a long term wealth creation process requiring constant shuffling and reinvesting the earnings. Ironically, the bad news is that only 0.8% of money goes into investment. Whereas, on the other hand, if you're betting on the price, which obviously undervalues or overvalues the product, then you are a speculator. By the way, gambler, trader, speculator all mean the same. And this assumes quick money making process, but the probability of winning is like spotting a black swan in a river. Unfortunately, 99.2% of the financial flow is being speculated as we allow generously middlemen, that is money managers, to win the game, and for obvious reasons Dalal Street promotes speculation. Graham's classic definition of investment has 3 components. The first one is about conducting a thorough analysis, the second one is about working out the margin of safety, and the third one is about the returns. If one could consciously practice this, you are on the right lane. There is no shortcut to this. The first key element is to conduct a thorough analysis. Everyone is expected to do it by themselves. Don't outsource it to someone. Take either a top down or a bottom up approach. In this, I have shown Tata Steel as it is one of my personal favorite companies. Visit the company's website, get the feel of it, find out their vision, goals, financial records, historical backgrounds, and decide upon the value of the investment. In case if you don't have such favorite companies, start macroscopically and glide through sectors and then keep filtering to get your segment. Here, at this juncture, I have to refer to Ashwath Damodaran's quote, who is again one of my favorite authors, the father of valuation. He says that even Einstein would have had a difficult time applying relative valuation in today's stock market. The second one is all about margin of safety. No matter what, never overpay however an investment is exciting. This will minimize odds of error. This could be achieved by evaluating the margin of safety where there should not be any loss to your principal, and which he discusses in detail in chapter 20. To evaluate margin of safety quickly, Graham introduces a Gordon equation in this chapter. I'm not going to get into technical aspects as these days number of online resources are available which will help you to estimate the investment growth. I've just given you a snapshot of how exactly this model works. But in chapter 11, he has discussed in detail about this, especially for lay investors. And the third key element is all about the returns. One has to set the target for themselves but keep it achievable. And just to give a heads up, I'm showing you a couple of examples each in stocks and bonds and how they have grown over 10 years period. And throughout this book, Graham suggests investors to invest appropriately in stocks and bonds. So before moving, for new investors, stocks and equity are the same and bond and debt are the same. If you invest in stocks, then consider yourself as a owner of the organization, as the profit or loss will have an immediate impact on you. Whereas if it were a bond or debt fund, you are lending money to an organization, so in return you'll be paid interest periodically on your lent money, not in addition to the growth. As an investor, you could either be a defensive investor or an aggressive investor. In case if you think you cannot spend enough time on studying the current market and wanted to play safe with less risky stocks, and obviously which in turn will get you low returns, then you are a defensive investor. Graham suggests that 50% each in stocks and bonds will be a good bet for defensive investors. On the other hand, an aggressive investor is one who is ready to take high risk and spend quality time on researching, which might reflect in high returns. Importantly, in the case of aggressive investor, one should go diversified and also shuffle the portfolio as and when required. It's quite natural that when one sees the market going up or down, everyone will intuitively plan to purchase or sell the product. As the popular saying goes, buy cheap, sell high. Graham keeps insisting about committing one's emotions and behavior during both bullish and bearish market. So, a defensive investor can expect a consistent return but limited, whereas an aggressive investor expects to perform better than his passive equivalent, but her or his results may well be worse. To wrap up the first chapter, being an investor will help you grow your money, but got to be a long-term process, thoroughly researching and diversifying. But in spite of that, be aware an investor is likely to have 60% profit and 40% loss in his kitties. So if you still want to be a speculator, just be aware and do so with less money. So intelligent investing involves fundamental analysis that doesn't fluctuate with each passing trend. See you in the next chapter. Happy investing.